Good morning and welcome to the Killik & Co market update. This week, a new milestone for Microsoft has been reached, with the company reaching a market capitalization of $2 trillion. It doesn't feel like that long ago that we were wondering who the first company would be to reach a market cap of $1 trillion. Apple got there first, but we now have two companies with a $2 trillion market cap, Apple and Microsoft. Here on this chart, you can see the top 5 companies in the world in terms of market cap. So behind Apple and Microsoft, we've got Saudi Aramco, Amazon and Alphabet. Microsoft shares have risen this week following the unveiling of the new Windows 11, which is due to be launched very shortly. And back in 2015, Satya Nadella, who is Microsoft chief executive, published a book called Hit Refresh about Microsoft's strategy, which is a really good read. But in there he talks a lot about how there are many areas in which big tech companies could partner with one another rather than having to compete. So I thought it was quite interesting that in the latest Windows 11 update, Windows will be allowing Android apps, which are owned by Alphabet, to run on Windows desktops. Here's the Microsoft share price chart over the last 10 years, and as you can see, it has more than doubled since 2019 when the company hit that $1 trillion market cap. But it's important to note that despite the huge rise in the share price, the shares are not necessarily more expensive than they were back in 2019. If we consider the price to earnings ratio, it hasn't actually moved a great amount in the last 3 years. The reason being that yes, the share price has risen, but the company's earnings have also risen, and therefore the price to earnings ratio has remained fairly constant. The Federal Reserve has released the results of the latest US bank stress tests, which does sound like quite a dry topic, but actually the results paint a very reassuring picture of the US banking system and therefore the US economy. US banks are required to have a minimum Tier 1 capital ratio, which essentially means they have to have a minimum amount of capital in relation to the riskier assets that they hold on their balance sheets. When the Federal Reserve conducts these stress tests, it comes up with various negative scenarios and it models to see what would happen to the bank's capital ratios in the event of these scenarios actually happening. So here's what the Fed said about the stress test this year. This year's hypothetical scenario includes a severe global recession with substantial stress in commercial real estate and corporate debt markets. The unemployment rate rises by 4 percentage points to a peak of 10.75%. Gross domestic product falls 4% from the fourth quarter of 2020 through to the third quarter of 2022, and asset prices decline sharply with a 55% decline in equity prices. So this really is a very negative scenario. However, the Federal Reserve then says that under that scenario, the 23 large banks would collectively lose more than $470 billion, with nearly $160 billion of losses coming from commercial real estate and corporate loans. However, their capital ratios would decline to 10.6%, which is still more than double the minimum required amount. So what this is really saying is that banks are now strong enough to withstand this very negative scenario. So as a result of these stress tests, the Federal Reserve will now be removing the capital restrictions that were imposed on banks following the coronavirus crisis, and that will free up banks to return capital to shareholders in the forms of dividends and share buybacks. So the results of these stress tests are very good news for US bank shareholders. And finally, UK supermarket Morrisons has received a bid from a US private equity house, which, as you can see from the chart, caused a huge jump in the share price. The bid was rejected for being too low, but the share price is still trading above the bid price, which implies that the market is expecting another higher bid to come in. UK equities are currently relatively cheap in comparison to their global peers, and furthermore, sterling is still relatively weak compared to where it has been over the past decade, and those things combined do make UK assets look attractive to overseas buyers, so there is some concern that UK companies will continue to be targeted by overseas investors. Moving on to have a look at next week, we're not expecting results out from any companies on the Killik covered list, but we are expecting results from cruise company Carnival and Primark owner Associated British Foods. That's it from us. Enjoy the weekend, and we'll see you next Friday.